Hi, Sir Charles Kelly. You may have heard in the news in the UK that the Skipton Building Society are launching a 100% mortgage, and the criteria will be based on paying 12 months of rental payments successfully, obviously, and as well as other things. It's going to be quite a strict criteria. This is one of the first 100% schemes that does not require a guarantor or any other form of payment like the Barclays one. That's come on the market for several years, some say for over 10 years. I remember the days when 100% mortgages were quite abundant, and you could get loads of them. You can get 125% mortgage from the Northern Rock at that time. And now we're seeing one creep in. Now, are all lenders going to follow this? I don't know. I don't think they're all necessarily going to jump on the bandwagon, but it always struck me that with lenders, they always seem to launch these type of schemes when we're coming to the top of a market, when everyone's scrambling to buy and the prices have topped out, and then they all start throwing money at the market. When the market is at the bottom and it can't go any further, it's flatlining, they don't want to lend. They say, oh no, we can't lend. It's not suitable security. When in fact, if they lent on those properties, they're very unlikely to go down any further, and they've been bought at very cheap prices. But now when prices are near record levels, I mean, they have come down. They've come down for the last 7 months, according to the nationwide figures. They're down on the year. They're not moving up. But it does seem strange that the Skipton are moving into this market. Maybe, I mean, they say they do it to help people. Maybe they just need more business and they're looking to lend money. But fair enough to them. That's good for first-time buyers. And we're also hearing news that in the mortgage market that more first-time buyers are extending mortgages beyond the traditional 25-year term. And this is a new move as well. This is lenders allowing longer mortgages to go on, maybe to 35, 40 years even, and this is to keep payments down. Now, in one example I heard on a TV show, someone was able to save £200 a month by extending it from 25 years to 28 years. And that means also that the lender can then maybe lend a bit more because there's more affordability there. The downside to this is that you will pay more interest over the long term. You will pay a lot more interest in 35 years than you would in 25 years, obviously, because the loan is outstanding for longer. But I think it's a good idea because you've always got options then. If it gets you on the ladder, it gets you property that you need. Later on, when you're earning more money, you can pay down that mortgage a bit faster. You can increase your payments. And on a repayment mortgage, if you increase your monthly payment, it has an effect of bringing down the term of the mortgage. The lender is a bit crafty. They just move the term of the mortgage down, and you would pay it off anyway. So if you can start off with a 28 or a 35-year mortgage to get you on the ladder, and then next year maybe increase your payments by 30, 40, 50 pounds a month, you would offset that extra cost in interest. Now, that's not an exact figure, so don't quote me on that, but I think you can offset that cost by just clearing the mortgage a bit early and making overpayments on the mortgage. So for me, it's a no-brainer. If you cannot make the payments on what you want to buy, then go for a longer term. In fact, I can't see the problem with having a lifetime mortgage like they had in Japan a few years ago. Prices got so high that you would just have a lifetime mortgage, and it just died when you died. And you're able to pass that mortgage with the property intact onto your children. Now, lenders don't allow that here, and I think that's wrong. There's so much hassle with probate here. The lender wants the mortgage paid off before they can, the property can be transferred and all this sort of stuff. It's a major hassle. Whereas if it could just be transferred on to the heirs, that would be so much simpler, as they do in other countries. So mortgages should be transferable. So there we are with that. And I suggested this to a government minister once. I said, why don't you just allow lifetime, even interest-only mortgages? And he just said something ridiculous like, oh, we don't want a mortgage war. What? I honestly, this guy was an idiot. But there you go. I don't see anything wrong with that because people are paying rent all their lives, so why not pay an interest-only or a capital and interest payment mortgage all their lives? At least they're in the property that they own, or they technically own, the lender owns it. And you've got to remember that, in 25, 30 years' time, if you've got a mortgage of, say, £200,000, then in 25 years, 30 years' time, that's going to seem like £20,000, and you'll probably just be able to pay it off from your savings or your pension fund or a credit card. It's not going to be a big deal. So I'm a lot more flexible when it comes to borrowing money. I've always done interest only on my buy-to-lets. I've had interest only on residential, although they don't really allow that now. So that's the two developments today. Other developments are that inflation has gone down in America. Don't forget they increased their base interest rates last year. It's gone down below 5% now. We're expecting that inflation will come down in the UK due to energy costs coming down in the next month or so. However, the Bank of England meet tomorrow, and I think the Monetary Policy Committee will probably follow the European Central Bank and the Federal Reserve, and by increasing rates by 0.25%. This is also to protect the value of the pound as well as bring inflation down. And that's what they're going to do. They don't care if you're poor. In fact, the chief economist, Hugh Pill, said a couple of weeks ago, people must accept they're poorer and not ask for pay rises. Businesses must accept that they're poorer and not put their prices up because of inflation. It's irresponsible. It's laughable, really. It's so ironic that these guys caused inflation by printing all this money. They said it wouldn't happen, that quantitative easing would not cause inflation. Then they said inflation was transitory a couple of years ago. It wasn't, it was just a temporary thing. And now they're telling us to be poorer when these guys in the Bank of England are on hundreds of thousands of pounds a year. Hugh Pill is on around 190,000 a year, plus his pension, plus benefits. That is probably equivalent to $250,000 a year. He lives in a fancy home right in the middle of London. The Bank of England governor, Andrew Bailey, he's on about $500,000 a year. For what? For putting up interest rates every month or so. No, it's a joke that they're telling this. It's disgusting that they're saying this. They should be fired, actually, in my opinion, for saying that, for telling us that we should be poor. It's like, telling the peasants to, remember that thing in Marie Antoinette, let them eat cake, let the peasants just get on with it, let the peasants be poorer while we sit on our thrones and in our ivory towers. I was so horrified by that. But they don't care if we get poorer. They don't care if they cause inflation and then let us pay the price for it, because we are paying for the price for it, whether you're paying for it in your mortgage payments, whether you're paying for it in the loss of value on your savings. We, the people, are paying for that problem that they have caused. Right, so there you go. That's my rant of the day. But anyway, I think interest rates will eventually come down, maybe by the end of the year as inflation creeps downwards, when they eventually get it under control. But don't forget, the Bank of England's inflation target is 2%, which is another ludicrous target, and inflation in the UK is still over 10%. So let's see what happens. They're expecting that the price of fuel, the wholesale price of fuel and gas has come down, so that should be eventually, finally, passed on to the consumer, and that will bring down costs, because people are suffering out there. Lots of people have found that their mortgage payments have doubled and even trebled in the last year due to these interest rate rises. So people are really suffering out there. So I hope that we'll see some respite for those people and get back to some sort of normality in the economy. So let's see what happens. That's my report on where I see the property market. I think property prices will still continue to either flatline or fall. Some people are saying it could be a crash. We don't know. It depends on what the government do. But I think there'll be a lot more cheaper properties around. In fact, if you look on Rightmove at the moment, you'll see that in some areas 50% of the properties have been reduced in price. If you exclude things like flats and new builds and that sort of thing, you'll get a better idea of what's really going on. But roughly 50%, according to one survey, of properties have been reduced by the sellers on Rightmove. I'm finding as an estate agent that stuff is not moving as fast. Good properties are still moving. Quality properties in the right areas that people desire to have, they're moving, but the rest of the stuff is sticking. And the sellers are either going to have to come down to a more sensible asking price, or they'll just take it off the market and sit on them, I guess. So let's see what happens. One option you've got, if you can't sell your property but you want to move, is you can do a let-to-buy mortgage. You can let your property out, rent it out, and pull out some equity and use that to get the property that you want, another mortgage on the property you want. I've done this before in the past. So look, thanks very much for listening. If you're worried about money, if you need any money help, do check out my courses, check out in the link below, and we'll help you take things further so that you can get control of your finances and build real wealth. Thanks very much. This is Charles Kelly. Bye for now.